Stay with us until the end of this video to uncover how the recent silence from the Bank of Japan and the Ministry of Finance is shaping the landscape for Japanese equities and the foreign exchange markets. When major policy headlines go quiet, what underlying forces are truly steering the yen and the Nikkei 225? Let's dive into today's market tranquility. To grasp the significance of a quiet headline day, we need to understand the broader macro context of Japanese monetary policy. For months now, global markets have been on high alert, reacting to every comment from the Bank of Japan and the Ministry of Finance regarding interest rates and currency interventions. Typically, statements from central banks trigger immediate volatility in the yen and equity markets. However, when communication slows down, market participants must recalibrate their focus back to fundamental economic trends, away from central bank noise. Over the last 24 hours, we've seen no major announcements, interest rate changes, or currency intervention signals from Japanese authorities. Key benchmarks, like the Nikkei 225 and significant currency pairs such as US dollar to Japanese yen, have shown a drop in news-driven volatility. In this absence of unexpected policy shifts or official warnings, trading volumes and order flows suggest a consolidation pattern. Investors are now shifting their focus from immediate policy shocks to broader macroeconomic factors, relying more on technical analysis instead of reacting to fresh headlines. On social media and trading desks, market participants are noticing this low volatility environment. Traders report that technical chart setups are currently taking precedence over news catalysts. In the absence of sudden statements from policymakers, short-term sentiment is being governed by established support and resistance levels. On platforms like X, traders highlight that range-bound strategies are dominating the scene, while everyone remains vigilant for any subtle policy cues that could disrupt this period of calm. Market analysts and institutional observers point out that periods of silence from the headlines often precede significant macro transitions. While the lack of immediate official action provides short-term stability, underlying structural dynamics are still very much in play. Analysts emphasize that global interest rate differentials continue to drive capital flows. Institutional desks are using this quiet window to assess medium-term central bank trajectories rather than speculating on immediate policy surprises. What does this policy calm mean for Japanese stock markets? For the Nikkei 225 and broader equity sectors, the lack of policy surprises allows macro sentiment and corporate fundamentals to steer price movements. In these quiet headline environments, stock performance aligns more with global equity trends rather than being shaken by currency-driven shocks. Market participants are paying closer attention to sector fundamentals and international economic cues, all while waiting for clearer guidance from monetary authorities. Turning our gaze to foreign exchange and international market dynamics, the stability of US dollar to Japanese yen remains closely tied to yield differentials. In the absence of direct comments on intervention or rate changes from Japanese officials, currency traders are focusing on the trajectories of major global central banks and the spreads in sovereign yields. As long as interest rate gaps between Japan and other countries persist, these structural factors will continue to drive yen movements across global currency markets. For individual investors, these quiet headline periods present a crucial opportunity to reassess risk management strategies. First, avoid overtrading in narrow range-bound conditions where whipsaws can occur. Second, keep an eye on upcoming central bank communication dates and economic releases instead of reacting to short-term price swings. Finally, ensure you maintain a balanced portfolio across asset classes to weather sudden volatility when policy signals eventually resurface. Looking ahead, here are 3 macro scenarios assessed by AI analysis. In the base case, Japanese monetary policy continues with subtle adjustments, leading to range-bound trading for US dollar to Japanese yen and stability in equity indices. In a bullish yen scenario, hawkish communications or tightening measures from the Bank of Japan could narrow international yield spreads, prompting a yen recovery and temporary revaluations in Japanese equities. Conversely, in a bearish yen scenario, If global interest rates remain high while Japanese policy stays accommodative, we could see renewed yen weakness and heightened market sensitivity to potential future intervention signals. In summary, first, the official silence shifts our focus back to underlying macro factors and technical analysis. Second, interest rate differentials continue to anchor FX trends. Finally, disciplined risk management is essential during these low volatility phases. What's your strategy during quiet market periods? Share your thoughts in the comments, like this video, and subscribe for ongoing insights into the Japanese market.